A lot of investors appear to believe that rental properties are a lot safer than REITs. They believe so because REITs are publicly listed and quite volatile. Last year, as an example, REITs dropped by 29% on average. And it's fair to say that their valuations can change quite drastically from a quarter to another. Rental properties, on the other hand, don't have a daily quotation, and that gives you a greater sense of stability. But are rental properties really safer than REITs? That's the topic that I'm gonna discuss in today's video. Hey everyone, this is Jussi. I run an investment firm that specializes in real estate investing, but unlike most other real estate investment firms, we don't invest only in private properties, we also invest in REITs and other publicly listed real estate investments. And I strongly believe that REITs are actually a lot safer than rental properties, and in today's video I'm gonna give you 5 reasons why that is. Reason number 1, rental property investors will use a lot more leverage than REITs in most cases. Today, the average loan-to-value of REITs is only around 35%. In comparison, rental property investors will typically use around 80% loan-to-value. And higher leverage can lead to higher returns, but it will also naturally result in higher risk. If you're 80% leveraged, just a 10% drop in your asset value would mean that you lose half of your equity. What you see traded in the REIT market is the equity value. And so when you take that into account, I think that the equity value of rental properties is actually quite a bit more volatile. Yes, you don't have a daily quote, but if you try to sell your property on a daily basis, you would constantly get offers that are 5% lower, 10% lower. People try to negotiate your price down, and so your equity value would actually be very volatile. Reason number 2, rental properties expose you to great liability risk. When you invest in a REIT, you become a minority shareholder of a publicly listed company, and so you enjoy its limited liability protection. You're not the one who's going to be signing on the mortgages. You're not the one who's going to get sued by the tenants. You're well protected. But when you buy a rental property, even if you have an LLC or you have some insurance, you'll still probably have to be the personal guarantor of the loan that the bank gives you. You're also the person that's going to get sued by your tenant. And so it exposes you to much greater liability risk, and this is often underappreciated by people. Reason number 3, rental properties are concentrated investments. When you invest in a REIT, what you're really doing is you're buying an interest in a large pool of properties. Most REITs are going to own hundreds or even thousands of properties. To give you an example, Realty Income owns over 10,000 properties. I think that it has properties in every state in the country and even in foreign markets in Europe. So you get really wide diversification. If one specific real estate market isn't performing well, you're still gonna be fine. But if you invest in rental properties, these are high ticket investments, and so most of us won't be able to buy more than 1, 2, or a few more. And most of your properties are likely going to be in the same neighborhood so that you can make the management efficient. If they're not in the same neighborhood, they will be in the same city or state. And being concentrated can lead to higher returns, but it also leads to much greater risks. Reason number 4, rental properties put the lives of people in your hand. And this is something that I think is greatly underappreciated. We're always all looking at our Excel sheets, trying to calculate returns and mostly considering financial risks. But when you're buying properties, you're going to be dealing with a lot of people, and these people are actually going to be living in your assets. And so this brings some social issues as well that are going to be inevitable. You might think that you're really good at selecting the right tenant, and so that you're going to be able to mitigate these risks these ways. But you know, if you do this long enough, it's only a question of time before you run into a bad tenant. And that's because people change over time. You know, we are human beings. We can be quite volatile. We are emotional, social creatures. Maybe your tenant loses his job. Maybe he gets divorced. he has some financial issues, anything can happen, people can change for the worse, and you're gonna be the landlord of that person. You're gonna have to deal with it. And I've heard so many stories of landlords being threatened by their tenants or worse. And so owning rental properties is most likely gonna cause you to lose some sleep at times. With REITs, you're perfectly shielded from these risks because you have a professional management team take care of it for you. Reason number 5, rental properties are illiquid. And so selling your property someday might be very complicated, time-consuming, and expensive. Even right now, a lot of people are trying to sell their rental properties because they fear that property prices are going to drop in 2023. But there's no transactions happening. There are not enough buyers right now. Interest rates have risen so much that people cannot afford to buy homes at the moment. With REITs, on the other hand, yes, their values are more volatile because there is a daily quote, but at least you have a daily market with liquidity, and you can sell your shares anytime for very low fee or even no fee. So if you don't like the direction your REIT is going, you just sell it and you move on. I think that's a major advantage, and it lowers the risks of REITs. So here I have a bonus reason for those of you who stuck till the end. REITs are also safer than rental properties, especially today, because they are priced at large discounts to the net asset value. And what this essentially means is that you get to buy real estate at a discounted price through a REIT market. Just to give you an example, BSR REIT, which is a REIT that specializes in Texan apartment communities, is today priced at a 40% discount. So you get to buy an interest in its portfolio at roughly 60 cents on the dollar, and clearly that's also going to reduce risks, because if now property prices began to drop, you have some margin of safety there because you only paid 60 cents on the dollar instead of full price. And so to recap, I think that rental properties are a lot riskier than REITs because here you're making a private, illiquid, concentrated, liability filled, management intensive, and highly leveraged investment. How are you going to tell me this is safer than a REIT that's public, liquid, diversified, you enjoy limited liability, you enjoy professional management, and you get to do this investment today even at a discounted price, so you have good margin of safety. I think that put this way, there is no doubt that REITs are a lot safer than rental properties. It's not even a small difference. I think they are really materially safer. And so yeah, that's my thoughts on this topic. Thank you very much for all of you who watched this video till the end. Please like and subscribe and let me know your thoughts in the comment section below. I do weekly videos on REIT investing on this channel, so if you're into this type of content, please subscribe, and also feel free to follow me on Twitter where I post real-time news on my largest REIT investments. Otherwise, see you at my next video. Bye.